flex, flex, your hustle. Flex, 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 your hustle. Flex, 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 your hustle. Flex, 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 your hustle. Flex, flex, hey, flex, your hustle.
Welcome back to the Flex Your Hustle podcast. And we've been gone for a while, but we're back now with more and more gems for you. And today we have a very special guest, Christopher Freygang. He is a business development manager and a certified financial planner. Very few people of those in Namibia. How does it feel to be on the show, man?
No. Thank you so much for having me, man. Obviously, the Flex Your Hustle podcast is something that I believe in, I stand for. So I think giving those gems and out there to the Namibian people, I think it's important. So thank you so much for having me, man.
No, it's an honor to have you. I figured, it would be a great time to have somebody who has insight and understanding of financial planning.
Yeah.
And where would put us in the next few months if we actually took the advice, So just to get back into it, you are a business development manager. How does that look like?
Yeah, so basically, I'm a business development manager for one of the boutique private wealth firms in Namibia. So that means we do wealth management. So looking at corporate, retail and institutional clients. So the man on the street that has some money lying around in the private wealth space, we basically manage that portfolio, whether it be from an investments perspective, retirement perspective, stockbroking perspective. We holistically help him achieve his financial goals. Same for corporate and institutional clients, meaning your businesses as well. How we help them like with their cash flow management. And actually just make your money more at the end of the day, and helping you do that with the least amount of risk but the highest amount of return. But then as well looking at retirement annuities, looking at pension funds, the administration of pension funds, long-term insurance, your life insurance, critical illness insurance, actually helping the people knowing when to take out those type of policies and not just unnecessarily giving advice. And the difference between us and a mainstream financial services companies that we provide, obviously, we play in the private wealth space. So it's the advice is much more tailored, if I can say.
When you say private wealth, for the average person trying to understand what private wealth is, what would that mean?
I would say in layman's terms, not to confuse anybody, it's just a bit more money than your normal man on the street. Let me say that. So helping clients that have a bit more excess money lying around, that they actually want to invest and actually want to grow their wealth using different strategies that are out there in the investment space. Yeah, I don't know if that answers the question.
I think it kind of does, because I mean, with private wealth, you mentioned also the managing of their cash flow as well.
Yeah.
And the risk planning. Everyone's ideal situation is that they have money that they've invested.
Yeah.
It's low risk, high return. That's everyone's dream. But
That's
I don't think that's
dream.
always the case.
So yeah, that's the thing. If it sounds too good to be true in the wealth management space, it probably is. I mean, if someone's offering you crazy amounts of returns for a low amount of risk and it's guaranteed, that's almost impossible. Almost nothing is guaranteed in the investment space. So meaning that the higher risk you take on, potentially the higher returns you get. But obviously there's a capital loss, the risk of capital loss in there, meaning that you can lose all of your money. And certain asset classes and certain investment vehicles are obviously just more riskier than others. Some are more regulated than others. Some aren't even regulated at all. So there's a variety of options out there. But it depends what's the best for you.
I guess in that situation, it would be something that the average SME would not be able to participate in that. But looking at the successful businesses that have grown out of the SME space, those are the ones that will be able to participate in that. But I would now follow up with a question to say that, and someone who just owns an average business, how do they end up being in a position where they can take part in investing in private equity?
So it depends. Would it be from a business perspective, or would it be from an individual perspective? Because if it's from a business perspective, it would depend what type of business it is.
Well, I think in this case, let's talk more of the personal perspective.
Yeah.
Because I'm looking at the average guy, right?
Yeah.
He's running his business. right? He doesn't have a salary, but he's running his business. That's his main source of income.
Yeah.
And he wants to put himself in a position where he is able to create wealth that will keep him paid,
Yes.
whether the business suffers or not.
Yeah.
Yeah.
No, I 100%. So obviously, if you're running a business like that, you would have to look at creating an emergency fund for yourself as well, because obviously the business environment is very volatile. It can change in a day or two. So having a set amount of funds in a very stable and secure type of asset class like a money market, just so that you can fall back on should your business not perform so well or whatever the case may be. Then you need to look at medium to long-term investments that is actually built around wealth creation. And that is type of money that you build a certain amount in your portfolio that you can actually live off without living or relying on a salary. So meaning that you run a business that you're getting a salary from or profits from, but you can afford to directly reinvest those profits because the interest that your investment portfolio earns is enough to obviously sustain your daily living.
Yeah, I've actually heard of that. There's this colleague of mine, he once explained to me where like there was an investment opportunity, I'm not sure, with Capricorn,
Okay.
where he would be able to invest like 250K and then get a yield on it every month and survive off that. But I'm thinking like 250 is too small.
No,
still.
it's way too little.
It's way too little for the interest rate. But in that case, you know, I understand the concept of putting the money away in the case of an emergency.
Yeah.
I think that happens quite often when something tragic happens in business and you were not planning for it, you know, whether it's the car dying or the shop even burning
100%.
down, the most craziest of things.
Yeah.
But having an emergency fund plays an important role because you can not only survive on that, but rebuild the business afterwards.
Yeah,
Yeah.
exactly. So let's look at a normal person that works an 8 to 5 every day, having an emergency fund, and you rely on a salary to obviously make your monthly, let's say, income and expenses work. Having an emergency fund, and without having that emergency touch into your monthly cash flow, that changes the game. Because then you can touch from an emergency fund that is growing every single month, month to month, it's gaining compound interest, but you can pull money from there without touching your monthly cash flow. So if you have to fix a car and it's 4 or 5K, you don't want that 4 or 5K to come from your monthly income because that messes up your monthly cash flow completely. And that's how you end up with no money at the end of the month. Whereas if you have an emergency fund that you contribute something small to each month that you've built up for a certain amount of time now, a certain period of time, you go take the money from there and you replace it slowly but surely because your monthly budget is in place and you know what can actually come from there or what can potentially affect your monthly budget. So having your monthly cash flow being affected as little as possible, I think that's where the goal is for salaried guys like myself.
Yeah, because you know, I think the number one problem with cash flow is that if you can't budget it right from the beginning, you are constantly gonna have, and there's this thing that a lot of people start to say like, hey, when I get money, something always comes up.
Yeah.
But the thing is, that something is always gonna come up irregardless of the situation. I think it's more of a position of insulating yourself and insulating that cash flow so it's defended against whatever situation that comes by. Like you said, if the car breaks down and you need 4 or 5K, it's not coming from your salary. Next thing, you don't even have money for groceries, you know? So you're looking at it from the place of safety net. But after having that safety net, I would ask now, that emergency fund, is it placed in an account that gains interest of some sort, or?
Now, 100%. So right now, with the repo rate coming down, you're looking at about 7% on an emergency fund that would be invested in a money market. But because it's invested in a money market, it's very stable and secure, meaning that you have immediate access to it with minimal fluctuations. Meaning that if you've got 10K in that account, chances are it's not going to be 9K tomorrow because of the market dropped or whatever the case may be, because it's very stable and secure. So 7% is still more than what your savings pocket would give you. But yet we put our money in our savings pocket, we put money in our 32-day notice account. In my strong opinion, the bank is a transactional company. The bank is not an investment manager. The bank has an asset management company on the side that manages investments. But the bank itself, I'll use Bank Windhoek as an example, or the Capricorn Group. Capricorn Group have Bank Windhoek as a subsidiary, as their bank. But they've got Capricorn Asset Management on the side as the asset manager or the investment company. You don't invest with Bank Windhoek. Some people do within the savings products that they do have. But the real money goes to Capricorn asset management because that's where the real investments lie. Because the bank products give you low return on investment, essentially 4-5%. But now inflation is sitting at 5.5%, meaning that the value of this iPhone increases with 5%, but now the value of your money increases with 4%.
Yeah.
You think you're saving and you have an emergency fund, but the purchasing power of your money is actually becoming less.
Becoming less.
Whereas if you actually invest with a wealth manager such as us or an asset manager through a wealth management firm, we make sure that you at least beat inflation in the short run. If I don't know if I'm making
No, you're making sense because I'm understanding that, you know, I'm coming from Zimbabwe situation. You know, their inflation is crazy.
No, it's ridiculous.
The currency is always changing. Today you can buy bread with $100. Tomorrow that $100 is for buying sweets or stuff. And when I'm looking at that, I understand the inflation aspect of it because your interest rate is consistently competing with the inflation rate. And the moment the inflation rate becomes more, is now means that you are in loss. And the more time that money stays in that without being spent, you keep on losing more money. And I've heard a lot of people, specifically in Zim, in the situation where they've invested with like Old Mutual and stuff, and they invested a specific amount at the beginning. Let's say, for example, like $50,000 When they went to take it out after like 10 years of that consistent fluctuation, they only managed to take out like 900 US. You see, 900, 1,200. And it's led to so many court cases because people are like, where's the money that I put in the account?
Exactly. But that raises another issue of financial advisors and their competence in Namibia. Because I believe a large majority of financial advisors within the Namibian scope don't have the necessary investment management knowledge. So they don't have the fund knowledge. So trust me, when someone puts in a 10K now and they want to put it in there for 10 years, a financial advisor with the wrong investment knowledge will go put it in a fund that doesn't even beat inflation, and they'll go put it in a product that has high administration fees. So it eats into your capital. So meaning that you'll have less money after 10 years than what you had coming in. Whereas a good financial advisor will put you in funds for the right amount of time. They'll choose the right fund for you and you'll get the right returns based off like historical returns and so on. And even right now we're looking at it. In my position, I was a product specialist before I was a business development manager. So I was a product specialist, meaning for a certain product within a big financial services company. And I saw these things every day where the clients would come in after 10 years, but their money would have been eaten away because they invested in the wrong funds and of the high administration fees. But then guess what the catch-22 is? The products with the high administration fees that they sign you up contractually where you have to pay a certain amount every month, that's the one that pays out upfront commission to the financial advisor.
So they are more focused on getting the commission
than actually giving you the right advice or having the necessary investment knowledge or equipping them with the right investment knowledge to actually put you in the right funds. But with that, the same being said, there are guys that are really good at what they're doing out there. And those are the guys investing your money in the right funds, doing it the right way and actually helping your money grow. So let's say if you invested about 10K last year, January, 2024 January, and you invested it for at least, let's say, depending on how long you want to invest it for, meaning that how long you invest it for will determine the asset class or the fund that a financial advisor would put you
accessible,
in. If you put it in for the long run, which essentially most of the time you'd be put in a predominantly equities or stocks based portfolio, you should have at least seen 15% growth year on year. If you didn't for long, let's say if your intention was for long term, then that financial advisor didn't put you
in a wrong fund.
Because all of the top performing funds at least did between 15 and 25%.
So that's like guaranteed return on the investment.
Not guaranteed at all.
Not guaranteed.
The global markets and the South African markets, Namibian markets, they had a very good past, let's say 24 months. But if they put you in for the shorter run, you're looking at least 7 to 7.5% return with an investment product that doesn't have more than, let's say, 2 or 3% admin charges. So it's two sides of the curve. And then obviously, if you're looking at the retirement funds have a whole pension funds act that govern the way they need to be invested.
Okay.
That's a whole different
arena.
That's a different conversation,
Yeah. Because there's something that you mentioned. You mentioned that the average Joe, right? The average person, some people are investing with, you said there's Capricorn and there's Bank Windhoek, right?
Yeah.
They are split into two. And then now there are some people that go and invest with Bank Vinduk,
Yeah.
or like a net bank or an FNB, right?
Yeah. In your savings pocket.
Yeah, in your savings pocket. You know that account that you see on your phone, your mobile app.
100%,
right?
yeah.
But then you are saying that it's better to invest in a money market. How does that work?
Yeah. So just putting it simply, I think the most simple money market that you get is in the form of a unit trust with all your main companies. You've got Old Mutual, Sanlam, you've got Capricorn Asset Management, you've got us at PSG Wealth. It's in the form of a unit trust.
Okay.
Whereas your bank product is in the form of a bank savings product. Where that bank savings product, they also invest in interest-bearing instruments, aka money market, but then they give you returns of 4.5%. Whereas putting that money into the same money market that sits with an investment manager, you get 7%. So meaning that you get 2%, 3% extra growth in the shorter term basis just for putting your money in the right unit trust.
Okay. Because as far as unit trust, what is that specifically? Because I've heard the word trust thrown around a lot, and so many people on social media are talking about it and the benefits of having a trust.
Yeah.
But what is a unit trust?
Yeah. So just for clarity, a trust is one thing on its own, where you open up a living or testamentary trust for you and your family or whoever the beneficiaries of the trustee is.
Okay.
But then a unit trust is an investment vehicle.
Okay.
So unit trusts, they also call it collective investments or mutual funds.
Okay, I've heard of that before. Yes.
So that means, let's say we are 4 in one group. I'm going to put it very simply. You give 1,000, all of us give 1,000. Then we've got 4,000 at the end of the day. Then an investment manager, portfolio manager sits with that 4,000 and they sub-invest that money into different asset classes based on what the goal is of that certain unit trust. In a unit trust, you've got different funds with different mandates from short-term to long-term bases. So let's say on a short-term basis, a money market unit trust, they go invest in interest-bearing instruments that are very stable and secure, things like treasury bills, government bonds, and so on. And then based off the returns they get from that 4,000, that determines your growth at the end of the day.
Okay.
So it's mutual funds, so money bundled up together, managed by a investment portfolio manager that basically manages where the money goes, and based on where he puts the money, that gives you an average return, and that gives each one their $1,050 back at the end of the day, if the return was a certain amount, if I can put it that way. Does that make sense?
Yeah, it does make sense. I think, watering it down to the most basic version, I low-key thought of it like I don't like the word a stokvel to a certain extent, because our parents used to do that thing where like it would be your friend's mom and your other
They all
homie's
put
mom,
money together,
and then it keeps going in a circle, right?
100%.
But then in that situation, there's no growth of the money. It's just that the money is just moved
100%.
and paid out differently,
So,
but in this case, you are gaining interest.
So let's look at it like a stokvel. A stokvel is not a registered and regulated type of model, but let's say an asset manager would be. It's the same as a stokvel, where a lot of people put money together through a brokerage or financial advisor, and they have a money manager called the portfolio manager. He takes that money and he decides, sharp, I'm buying that, I'm buying that, I'm buying that. Or I'm investing in that company, I'm investing in that company, I'm investing in that company. But it's so broad and it's so deep that at the end of the day, those guys have a high level of expertise for them to understand which companies and which models to invest into. And then the average return of whatever goes on in the underlying funds, that gives you the return. And that ultimately you see your interest, your return on interest, and that's how your money grows.
That's how your money.
So it's a good way to tie it together. It's just that it's a stokvel that is managed by experts.
It's professionally managed. No one is gonna run away with the money through the month.
100%.
Yeah. No. In that case, we have spoken about investments. We've spoken about, there's something that you keep bringing up, and you keep mentioning the time frame of an investment. Why is the time frame of an investment important, or what role does it play in making sure or the type of yields you can get on an investment?
Exactly. So the time frame largely depends on what your needs and your goals are. So as a person sitting here, you can't have dreams and aspirations of building wealth or saving or investing if you don't know what your needs and your goals are. I mean, saving for a new iPhone, like bring up the iPhone situation again, saving up for a deposit for a car, saving up to buy a house. all of those things have time frames attached to it, and you yourself need to decide, okay, fine, this is how long I want to save for this specific goal. Then we as the investment managers, we take a step back and we analyze the market based on asset classes. So asset classes is where we would be putting the money. So your basic asset classes would be interest-bearing instruments, like I said, your money market that consists of treasury bills, government bonds, very stable, very secure. Those are your most stable and secure guys. But then you move up into things like equities, which is stocks within companies globally and locally. Then you look at things like property. You don't only have to invest in property through buying a house. You can invest in a property fund, which is the most volatile asset class of them all. Then we look at bundling those things together and creating a mutual fund. So different funds have different objectives.
So a mutual fund, just to get this right, it's a combination of different types of other funds.
Asset classes.
Asset classes, okay.
Yeah.
So if I'm combining investing in property in a property fund, I'm looking at stocks and bonds and government bonds as well. That's now a mutual fund.
That essentially would be a balanced fund.
Oh, okay.
So they put all of those, that's the asset allocation of that fund. So based off the volatility of that fund, meaning how does it fluctuate? So meaning equities and property would be your most volatile asset class in the short run.
And why is property so volatile? You know, I would think for real estate, you know, it's a very calm industry, but I'm always seeing on the news everything from rent always changing. That also plays a big role. But why is it property is so volatile? Because a lot of people speak on investing in real estate, but they don't mention how crazy the market is.
Exactly. So I'll put it simply. I'll put it very simply for anyone to understand, is just that the factors affecting the property market are a lot more than your other aspects. So you're looking at political factors, you're looking at environmental factors, you're looking at economic factors. All of that within a country and within a specific geographic region affects the property price. And essentially, that is where it fluctuates like crazy. In my opinion, I think property is the most volatile asset class to invest in. But then again, property and equities are the most volatile. Now you're looking at a fund that has predominantly equities, some property in there. Now you're looking at a very volatile fund. So essentially, you don't want to put a client there in the short run. You might put a client in there if you want to take a risk and the market is looking, or the market trends are pointing green towards equity and property and so on. But that is still taking a risk because it's very volatile in the short run.
Anything can happen, you know.
Anything can happen. But that's where you look at how investment companies spread risk across, let's say, different sectors, geographical regions.
That's why it has to be balanced at the end of it, so that, you know, it's not only relying on the most volatile aspect, but it's relying on also on the other investment opportunities that are less volatile. So knowing that in the case that the equity and property does not go right, the other investments
it can just balance the situation.
Balance it out,
No pun intended there. But just to get back to your question before I touch on that, so the asset class allocation of that fund will determine how long you want to be in that fund. Because if I put you in a property, fund, solely property, and you need that money in 6 months, but the market is down 20%, you're going to be upset with me. But if I put you in the money market that gives lower returns historically, but is stable and secure, and you need your money after 6 months, go, fine, there's your money. And now essentially in a 6-month span, you've got more money in your money market than you did if you had invested it in a property fund. But then looking at that from a 10-year perspective, the returns can almost be double, triple in the property fund as opposed to a money market. So money markets usually look like this, whereas property and equity funds do that.
You know, when I was younger, I tried to trade Forex, right? And I'll tell you why I'm bringing this up. When I looked at the markets, right, I got to understand that trading Forex is about when you go in the market and when you come out. And I think that's one thing that you are really mentioning, to say that you can't put somebody in a situation where you know the market is going to go down for a certain period and they just want to be in that period. You know, it's kind of like buying Bitcoin whilst it's dipping. It makes no sense that you would want to buy Bitcoin for the next 2-3 weeks and you see it's dipping and it's still dipping. Compared to somebody who will buy Bitcoin and will sit with it for like 3-4 years. It's much more different. And those short-term and long-term trades, they each have their own advantages, I guess.
Exactly. So you get guys that trade forex and crypto on a short-term basis, but that is the most volatile of it all. Whereas we won't take money from a client and play with their money like that, because we understand the risk for capital loss is way too high, because we are regulated by NAMFISA. A crypto, a Bitcoin trader, a forex trader, he's not regulated by anyone in the Namibian scope.
No wonder there's been so many people that been roped into these investment opportunities with forex guys and the Bitcoin guys, and the money never comes back. I was personally a victim. I remember a couple years back, I there was this opportunity. They were like, nah, invest a certain amount, you get like 40% back. And then I even went and I convinced my dad, like, yo, let's throw in some money. And then we put in, I think, like 16K. He put in a 10K, I had a 6K. Till today, we never got the money back. You know? We never got a cent back. And we're now looking at it and it's like, there is better investment opportunities,
safer,
average and safer, you know,
safer investment.
And you would want to be part of those as compared to the rock star ones that you see on social media, because they look nice.
It's all a facade.
It's all a facade, you know. And the person, the moment you're investing in something, and if you're not looking at the numbers, and you're now looking at how the person you're talking to dresses or is living, just know you are in the wrong. You check. Just know you're gonna lose
100%. So I believe there are guys that are making good money off forex and crypto. I really believe there are. But these are guys with experience. These are guys that know how to really, they have the reputation to really read the markets. But it's impossible to fully predict the market. That is one thing that's the game we do not play in. Because we think, let's say the projection we set out is that equities in South Africa are going to perform well for the next 3 years. Even though we think it's going to perform well for the next 3 years, possibly provide returns in 20% consecutively year after year after year, we're not going to put a client on a 3-year term, only on a 3-year term in an equity fund, because we understand that the investment horizon needs to be much larger than just 3 years for you to actually see the returns. Me having the knowledge and sitting with that, I will take the risk with my own money, and 100% I'll put that money in there. But if I lose the money, I know it's on my, or let's say it's on my own accord. But then again, needless to say, like I said, crypto and your forex is not regulated by the Namibian government or any regulating body in the Namibian scope. That doesn't mean you shouldn't do it. I mean, I've got some crypto in my portfolio as well. But I don't go put money in crypto that I need next month or next year.
Other people's money in crypto, you know.
Exactly. And I also do not try to really read the market that much. I mean, though you have those guys that work on a short-term basis, so buying and selling at a short-term basis. So stock broking, or essentially trading crypto, is buying $1 for 50 cents continuously at the right time. And if you manage to do that consecutively, that's how you make money.
That's how you make money.
But you need the knowledge and experience to do that.
And I think it's very risky. It's very risky because, like you said, the market is very volatile. Personally, for me, when I looked at the whole Bitcoin space, I came to understand that if I was ever to get into that space, I would just take some money, throw it into Bitcoin and leave it there.
Leave it.
Because I've looked at charts and it's like one moment Bitcoin is at 20,000. I don't know what, then it's down again. It comes back up. But in that situation, you know, what I would now follow up with is to say, let's talk about the average 25, 26-year-old. Right? They started work maybe a year ago. They are fresh getting that salary. Maybe, let's say, I don't know, what's the average salary you'd think someone who just started working?
It depends on the educated, what they study, what.
I think maybe let's give it a little bit.
Let's say 25K.
Yeah, let's say 25K, 25K.
Yeah.
How do they put themselves in a position where we've spoken about investment, we've spoken about the go-tos and what not to do, and what position they can be in, but specifically, what can they do now? This is now February. They get their salary end of Feb. What moves can they make so that they end up in a better position financially?
100%. That's actually a very great question, because a lot of people don't think that way. Okay, fine. How can I actually build my portfolio, start creating wealth, and actually think long-term with it, and while catering to the short run? So I will put as much disposable money as I can in a stable and secure asset class in the short run, because I don't have a lot of money. I don't have 20,000 a month to save. So I'm not going to enter volatile markets in the first 3, 4, 5 months off the bat.
Okay.
So first of all, what I'll do is I'll save as much money as I can in my money market. And then up to the point where I've, let's say, built a substantial amount. Let's say they put away 2 or 3K and they get to the point where they have a 60,000 in there.
Okay.
That's, let's say, over 3 year period. I will leave some money in there as an emergency fund because that's my stable and secure asset class. Then I'll start looking at diversifying my portfolio into equities, which is more long term, obviously for wealth creation. I think in the modern day, with us that have time in the market, anyone under the age of, let's say, 45, I think you should look at putting some crypto into your portfolio because I don't think crypto is going to go anywhere. And I think it's but a small portion of your money also for the long term. And then start looking at medium to, let's say, short to medium term options that you also, goals that you want to achieve in the next 2 or 3 years. Meaning that you want to buy a new car, you want a down payment for a new house, those type of things. And then scaling down on that, start putting some extra money away towards your retirement. Because if you're a working individual, your pension fund will never be enough alone to sustain your income post-retirement. Because now look at this, you work for, give or take, 35 years from the age 25 to age 60. Then you retire. You were only saving 10% towards a pension. But now you're 60 years old. Now you expect that money that you put away to sustain you for how many years? 20, 25 years?
Nah, it's impossible.
The same amount of money. There's no ways.
And the thing is with pensions, from what I've heard, the amounts they talk of having when it's time for claiming their pension, it's like 1M, 2M.
It's not a lot of
1 million, 2 million is not a lot of money. And you think a lot of people, they say it's a lot of money. It's like really a lot of money. If you survive, maybe you need like a 10K a month. To be honest with you, you worked 35 years, right? You want to go on a holiday. You want to go do this and that. You want to do all the things that you couldn't do because you were in the working space.
Yes.
And 2 million, you run through it in maybe 3-4 years. That's if you are lucky.
Essentially depends how much you can take from it. Obviously, the Pension Funds Act strictly regulates how pension funds pre-retirement and post-retirement are managed. Obviously, for you to have enough money that will last you throughout retirement. So that's the thing. Unless you're in a provident fund and you have access to all of your money, and you see people jump from job to job. When they jump from job to job, they have access to their pension, which is taxable. What do? They take the pension and they go on a holiday or they pay off
Shower the
a
pension.
Foshini or Sportsing account.
It's that thing of thinking.
Eish.
It's not that thing of not thinking of tomorrow.
Exactly.
Because and I never understood that and that my follow-up question would be that, let's say I work at a place, right? I'm 25. I'm working at place A, right? An IT company. Then I worked there for like 5 years, right? And I've been putting away pension money. Then I'm now 30. I get a new job somewhere, higher position, whatever. My pension moves on, right? On to the next. I can continue adding.
So you'll have a few options in that situation. You will have to move from the pension of your previous employer either to the pension of your next employer. If they don't have a pension fund registered there at the new employer, you either put it in a preservation fund, or you put it in a retirement annuity, or you withdraw it. Those are basically your 3 options that you have. In a preservation fund, you still have access to it in the first 3 years, meaning you can withdraw it. But now that's the catch-22, because all the money that you withdraw from your pension or from your preservation fund, sorry, let me rephrase that. All the money that you withdraw from your preservation fund is taxable. And all the money that you withdraw from your pension pre-retirement is taxable too.
So you're losing money every time you withdraw.
So you've got 100K in pension funds now. You decide, it's fine. I'm under 30 years old. I don't want to transfer it to my new employer. I want to chop that money. But instead of getting 100K, Namra chops you and says, okay, fine, boss, 30K is ours. You're actually only getting 70K.
Ish. I think it's not worth it, really. If you look at not only the tax that is involved with such a move, but now that we brought up tax, right? And now I'm 30, I decide to take that money, right? The tax man comes and takes his cut, everything. I finally learned my lesson about tax. I realized that, okay, I need to do my spending a bit more wisely, or get my funds out a bit more wisely. What position can I be in, or how can I get myself to be in a position where I get a salary every month, and that is already taxed. you know. But then after that, with the investment opportunities that I have, how can I put myself in a position where I'm taxed way less? Let's say I have one or two properties, I have two or three extra cars.
Yeah.
You know, I'm getting rent from the other properties.
Yeah.
The other two cars, one of them is a Yango. So I'm getting some form of income
Yeah.
in, but then I would want to be in a position where I keep most of the money to myself.
Yeah.
How does that go about?
So just generally already, we've got a very favorable tax system in Namibia compared to our peers, let's say in South Africa, because we don't pay capital gains tax. We don't pay, let's say, tax of like the interest that our investment accounts gain, other than dividend withholding tax that you get from your stocks that you've bought. So we've got a very favorable tax system. So with a retirement annuity, if you take out a retirement annuity, which is essentially a pensionable product, on the side in your individual capacity, you can claim up to 150,000 back in tax every single year. Not 150,000 essentially, but in contributions, meaning that the contributions that you've made towards a retirement annuity is 150,000.
Okay.
But now the catch-22 is that when you retire, only 1/3 of that money is paid out tax-free, and the other 2/3 you get an income from it. That money is taxed. So essentially, they give you the tax back that you pay on it right now, but then they go tax it when you retire. So it's a catch-22, but the tax benefit that you essentially get from it now is good. But then again, like I said, we've got a very favorable tax system in Namibia. I think our marginal
I
tax
never
rate,
knew that actually. You know, I would want to know, like, in knowing that Namibia has got a different situation concerning the finance industry and how it's policed.
yeah,
There is a lot of, I can't call them loopholes, but
Yeah.
essentially they are. You know, knowing that there's no capital gains tax, you know, it puts the average Namibian on a different plane compared to a South African.
no, 100%. I mean, even inheritance in South Africa is such a pain in the ass, because now you inherit a house from your parents, but there's capital gains tax involved. So you pay tax on the amount that the house market value increased by when your parents bought it 20 years ago. Because now they bought that house for 500K 20 years ago. Now that house is worth 3 million. You pay tax on that
On that 2.5.
on that 2.5 million.
You're-
Obviously, there's a very intricate calculation that is done to determine the capital gains tax. But they'll come chow you, and then now you're inheriting a house, but you need to pay 200K.
Hey man, and the thing is now, in God forbid, you know, the time that you're inheriting the house is important. That time you just you started working, you just bought your polo, you're staying in a flat, and they're asking for like 100 bands for you to get the house.
Yeah.
You know, it puts you in a very tight position, but knowing that Namibia doesn't have that. But when it comes to inheritance, I've had a lot of people dispute about inheritance.
Yeah.
How would I prepare myself so that my kids don't fight for my inheritance? What do I have to do financially to be in that position?
That's actually a great question, and that's obviously where estate planning comes into place. So the most important thing, or the biggest favor you can do to your loved ones if you're no longer here, is have a will in place, a will and testament that is clear and legally binding. So meaning that you write up a document with an executor of the estate or someone that does wills and estates, and you just depict how your money and how your assets will be spread across your beneficiaries, your dependents, the day you're no longer there. That's number one. Number two is ensure that you have enough money in your estate to cover your creditors. So the money is that you owe. So that's where things like life insurance are they're really useful tool to ensure that you've got enough money in the estate to pay your bond off, that your house, obviously, that you owed at your house, so that your beneficiaries can basically inherit the house debt free. And then obviously those small creditors, the sports in account, the furniture
The
account,
Louis account,
just so that there's enough money in your estate to cover your short-term creditors, and then there's enough money obviously to leave to your beneficiaries. So your will and estate will govern my car is going to who, my shares in this company is going to who. Till your clothes, you can decide, okay, fine, my clothes are going to this cousin, and whatever the case may be. And then these investment portfolios go to my wife, my daughter, whatever the case may be. Then, like I said, secondly, make sure you have enough money in your estate
to cover the
so that
creditors.
there isn't a deficit in your estate.
Yeah.
So that there can be a surplus. So at the end of the day, you've got a 1 million lying in your estate after all of your creditors have been paid, and then that 1 million can be spread to your beneficiaries or your dependents accordingly. Because what happens is that people pass away, there's no will and estate in place. So now it needs to go according to, let's say, succession acts in the Namibian space that is basically declared on a dependency basis, meaning your side chick can also have grounds to come claim for whatever the case may be.
Hey, that's
because
crazy.
they look at who was dependent on you, and they pay that money out accordingly.
So wait, as long as I was paying for somebody's lifestyle,
they can claim from your estate
on my estate
if you have no will and testament in place, 100%, because they claim on a dependency basis. But then if you've got your beneficiaries listed accordingly in your, let's say, your life policies, in your pension fund, and in your estate with a will and testament, that obviously makes it a lot smoother. But now you've got 2 or 3 kids running around there somewhere, and they hear, hey, that guy that they say my father is my father, he passed away, let me go here. And he comes in and he's entitled to a child's share as well. And that obviously creates a lot of dispute.
No wonder there's so much
in black families,
No wonder there's so much fighting. But now you mentioned a will, right?
Yeah.
And you mentioned having enough money to cover your creditors.
Yeah.
Right? There's 2 things I'd want to ask about. A lot of people, like I mentioned earlier in the podcast, they talk about having a trust.
Yeah.
Does having a trust push you a step further compared to someone who just has a will?
Yeah, so essentially a trust is it's a rich man's thing. Essentially, I always say the clients that we see, don't even consider opening up a trust if you don't have at least, let's say, 25M. If you're not worth 25M at least.
Okay.
Because there are other responsibilities that come with a trust. Because you need to nominate trustees in your trust, meaning that people that will govern the trust for you. Then you obviously transfer assets into a trust, so meaning that they no longer belong to you. Then trusts are also taxed at a certain rate, similar to what companies are taxed in the Namibian scope. You have to submit financial reports every single year, and all of those things cost money. So if your net worth is 2-3 million, you want to open up a trust because you want your kids to live a life, you're actually just giving yourself a lot more admin.
A lot of bills to pay, more bills to pay.
More bills to pay, more admin to do, where you can just focus on obviously creating your wealth or taking your wealth even further. And then when you've got about 15, 20, 25M, then you can start looking at obviously creating a trust, you and your wife, or you and let's say the entire family. You can create a family trust. And obviously the key benefits to that, because assets are protected within a trust and they're no longer in your name. So especially for business people and people, like I said, who have net worths of more than 15 million, 20 million, I would say you need to be worth a substantial amount before you even start thinking about opening up a trust.
I think that's some good advice, because the thing is, we watch a lot of stuff on social media. They tell us to do stuff.
Yeah.
Right? No, go open a trust, go open this and that. But then you need to have perspective of what exactly you're doing and the cost that it's going to incur, But then now my follow-up would be to say that in the case of family, right, or someone who is married, let's say the average Joe is 27, he finds his girlfriend, they get married, now they have their flats, the polo.
That's me now. That's me. That's essentially you're describing me right now.
You right now. So I guess the advice is coming from the heart. It's really personal.
Yeah.
How does one put himself in a situation where now he is either just about to get married or married, married, and what position what can they do so that them and their partner can build wealth? Because I read something online where it was like the average couple, a single person has 22% chance of creating wealth.
Yeah.
But a person who has a partner and they do the wealth creation together, they have a 72% chance. Which means already the chances are way high.
Yes.
But then how do you go about that specifically? Because a lot of people say have different accounts, have one account. It's a bit too much now.
Yeah, that's I think that depends from person to person, man. But I think the data will show you that a dual income household creates wealth a lot faster than a single income household, for sure, 100%. But I think at the end of the day, it depends from relationship to relationship. But I think from my perspective personally, I think you and your partner need to be on the same wavelength. You need to have the same vision, the same goals. You need to decide, okay, fine, what does our life look like essentially? From a career perspective, from a finance perspective, a lifestyle perspective. What are the things we want to achieve? What are the things we want to build towards? Once you've got an aligned vision and and goal set, then you can start moving towards that. And obviously, once you put your income together, once you get married, dude, there's no more that's your money, that's my money. Yeah, obviously you've got anti-nuptial agreements in place and all of that. But if we're building together, that's a unit. There's no such thing as that's your money, that's my money now. Even though I'm earning more money than my fiance or whatever the case may be, that is our money now. And then sitting together, creating our budgets and be like, okay, fine, these are our goals that we want to achieve together. Even though I have side hustles and side businesses doing a lot of stuff, she's got her own thing going on along the side. This is the money that we have coming in a month. These are the goals we want to achieve. And then actually intentionally working towards that. Because you see a lot of people that are earning good money, but they go buy, or they're married and they go buy Mercedes Benzes and they go buy big houses and they go do what?
Those push gifts.
And they just mess up the wealth. So you and your partner actually need to be aligned, have the same vision, have the same goals that you guys want to achieve together, and understand, like I said, that's not your money and my money anymore. This is our money. So I would say my girlfriend is quite fortunate. My fiance is quite fortunate that she obviously has me.
Yeah, no, definitely. Because that budget is gonna be on point.
So it's on point already. I mean, even at this point already, I mean, when we started dating and when she started working, I was already lecturing her. I was sitting with her, creating her budgets for her. This is how much you need to save. Okay, fine. What are your goals? What are your needs? We plan it out accordingly. And I'm like, fine, this is the money that you can spend. But also not forgetting that we like things. We are people at the end of the day. I mean, we're young. We don't have any responsibilities or major responsibilities or major debt as well. So we want to travel. But we also think, okay, fine, when we essentially buy a house, we want to buy it out of our pockets, cash. So we need to understand we need to be saving at least 15.
And there's a specific lifestyle you need to have to be in a position to do that.
100%.
You know, I look at a lot of... in terms of relationships and stuff and money, I think it's really up to us as gents to really take charge in that
you have
area.
to.
Because the thing is, like, yes, you know, women, they are known for being the most organized. You know, they can manage a lot of stuff at the same time. But I feel in terms of direction and planning, gentlemen need to be in a position where they plan the trajectory of the life that they're going to have. The thing is, people become complacent, you know,
100%.
and they just leave it up to luck. Like, we're going to figure it out, you know. But that already puts you in a deficit because anything can happen. The moment she says she wants to do this and that, you can say yes, and it puts you guys in a different trajectory. The next month, certain funds are not meeting up, and then it causes a whole lot of problems, you know. So I feel like the planning is very necessary.
No, 100%. And I think within the Namibian context as well, it's quite concerning. I think the caliber of men that we have out there in this modern day and age is concerning, because men are not leading, men are not ambitious enough, men are not courageous enough, men are not disciplined enough. I think it's a big problem in the Namibian context.
I think it directly translates in the economy. Because you will see the economy is flooded with the most numerous number of female entrepreneurs, managers. In every business that you go and look for, it's always managed by a female.
If you go look at specialty fields where, let's say, hard labor is not required. In the Namibian context, you go look at the Namibian statistics report, a labor report that was recently put out. A larger percentage of women are in managerial roles where it requires a specialty type of skill. So like I said, not hard labor, so not your whatever type of occupations. Even in the financial services industry, I guarantee you this, that you're going to look at 50% and above are females in managerial positions.
And it's not to knock down women, really, at all. We props to them for what they're doing. But I mean, gents need to be in a position where they pick up their socks, because a lot of, you know, what's happening now is the distractions are becoming so many. You got people doing gambling 24/7 now. Like, for me, this gambling thing has become such a disease that I can't even walk a distance without hearing somebody talking about gambling online,
betting, or whatever the case.
And a lot of people are seeing that as their financial solution to life. But even the money that you get from that, it doesn't last long at all. You know, and more with the women's side, they are so focused. After school, she gets a job. She starts climbing up the corporate ladder. Next thing, she's the manager of such and such a business. And it's going to eventually put men in a weird position in the future. Because
If it's not already, I think it's
already started. You know, you can already see the things that are happening.
I mean, how many? If personally, I know of so many single mother households. Whether that's older than I am, or in the current climate of our age right now. I think our climate or our age is a bit better. But if you look at the generation above us, let's say the millennials, let's say 1980 to 1990, whatever the case may be, there are so many single mother households. It is concerning. It's a pandemic on its own, man. And I think men need to do better within the Namibian scope. And that's why you need to sit together as men and look at your friends and actually be like, okay, fine. Are these people that I want to be like? Are these people that I look up towards? Are these people that can teach me something? Are these people that are actually morally and ethically aligned to what I want to achieve one day in my life? And then if that's not right, then why are those, or if it's not answering your question, then why are you friends with those people? Or why can't you correct those guys? Why are you sticking around and being friends with people that you don't see a future with? Or essentially people that you can look up to, or people that you can actually put on the straight and narrow. It's a pandemic. That's all I can say. I think that's a whole conversation for another day.
On its own.
We'll address it at the men's conference.
Yeah, men's conference is coming up soon. Yeah. But yeah, no, you know, with looking at all this financial spectrum, you know, since we have a couple of minutes left, I would want to ask you just a couple of things just to give guidance to the youth right now.
Yeah.
Right? A lot of the youth are coming out with NSFAF debt straight out of varsity.
Same. I'm sitting here with NSFAF debt myself.
Yeah.
I'll put it out there straight. I'm paying back though. I'm paying back.
Yeah, you're paying back.
Reluctantly, but I'm paying back. I'm doing the good thing and paying back my NSFAF debt 100%.
Yeah. So like for somebody who's just coming out of university, has their big NSFAF debt to pay, is looking for a job, or and whilst having a side hustle, is literally starting from the bottom.
Yeah.
Right? I understand that before they get into any investing or whatever, they need to have the knowledge.
Yeah.
And I'm aware that would have been the first thing you would have mentioned, because you need the knowledge before you do anything.
The knowledge and the discipline.
Yeah. But looking at after having the knowledge and the discipline, right? Because anyone can give that advice to say, no, you need to study about it and you have to have the discipline. What is the technical thing a young person can do to get them straight into the investing game, or into understanding the various ways they can create wealth, not only from the investment side, because a lot of people talk about real estate investing. There's the other one that I also wanted to ask about, to say like the life insurance. Yes. I heard from somebody, right? I had a conversation with a white guy.
Yeah.
You know, and they always have game. You should talk to them.
100%.
They have these little loopholes that they're using to buy houses and stuff, right?
Yeah.
He told me this. He's like, I have life insurance, right? And then I loan against my life insurance, or I use it as collateral.
Okay.
And then he uses that to buy his properties.
Yes.
And then he reinvests back the money in once he gets it from his properties. How does that go about? Or is that actually true?
Yeah, I mean, there are ways to go about it, but I think it works the other way around. You buy a house and the bank requires you to have life insurance that you put as collateral in the event that you die, that they have security in terms of money that will pay out to cover your debt.
Okay.
So what you can do essentially, and this is in countries where prime rates and interest rates are really beneficial, is that in the event where, let's say, your prime rate is sitting at less than 10%. In our case, it's not like that. We have pretty high interest rates that our banks charge in comparison to first world countries. So in first world countries, what they'll do is they'll take out a loan to buy a house. Then they'll obviously take out life cover as collateral to get that loan to buy the house. But because prime rates or interest rates are so low within these developed countries, with the premium that they're paying, the bond that they're paying back the bank at is so low that your rent will cover that. In Namibia, that's not the case, because you're paying so much money back to the bank in interest that at the end of the day, if you sublease that, you're not even getting all of your money back. And if rates and taxes come on top of that,